Hi everyone, thanks for joining us for this lifestyle webinar on smart strategies for your super. We'll get started in just a second with Shane Foster, your presenter. But before we begin, I'm just going to go quickly through the dashboard that you've got on the right-hand side of your screen with the webinar functionality. So it should look a little something like this. The design's changed a bit recently, but it all works more or less the same. So you've all been muted by default so that we don't get too much background audio. So if you want to interact with us, ask any questions, or have any comments, please feel free to do so just using the chat function in your dashboard there. You can also click the orange arrow icon to hide the dashboard and give you a bit more viewing room on your screen there. And the question panel, as I said, is there throughout the whole presentation if you have any questions. I'm just going to check that everyone can hear us okay by asking you to click the raise your hand button on the side of your dashboard there, just to make sure that the audio is coming through. Okay, great. So I'm seeing a couple of raised hands, a couple of people who haven't raised their hand there. So if you do have any issues hearing us or seeing the slides, please use the chat function or the question function in your dashboard to let us know, and we'll try to work out any hiccups that are going on. Okay, so it looks like most people can hear and see okay. Thanks for that. I'm just going to lower all of your digital hands, and we're ready to go. So handing over now to Shane Foster, the Head of Workplace Financial Advice here at Lifestyle.
Thanks, Dean. Welcome, everybody. We'll start off by just touching on the general advice warning. I am a licensed financial advisor and I can give financial advice, but today we're just going to have a general discussion about some of the things that we really need to consider as we go through our working lives. When I sort of think about wealth creation, for most Australians, we're really looking at how do we sort of manage our finances on the way through our life, and then make sure that when we get to retirement, we have sufficient funds to be able to retire comfortably. So what we'll do is have a bit of a chat about what does retirement adequacy look like. When we're trying to build our super or create wealth, we need to look at how our money is invested and also the contributions that we'll be making along the way by both yourself and your employer. We'll then have a bit of a chat about a super plan or just your super plan. We don't need to be platform specific. At the end of the day, there's just a couple of things I want to touch on around considerations you need to look at when looking at just your superannuation fund. So with the retirement adequacy, really the question is how much is enough? And for all of us, it's going to be different. So things that have happened in the past that make it different today is if we were 65 and we were retiring in 1950, financial planning in many respects was quite simple. A lot of the people back then didn't work that long in the workforce. They had an extended period in the workforce, and unfortunately, the retirement period was quite short. And what I mean by that is our life expectancy back then in 1950, if we were a 65-year-old, might have been 3 or 5 years. So retirement planning back at that time was actually fairly simple, as sad as that sounds. Today, though, it's quite different. We're going through and we're actually educating ourselves better, and then we're going to be in the workforce for a shorter period of time. So in the old days, I guess what we saw was that the income level was a lot lower. Today, incomes generally are a lot higher. And then our retirement phase is substantially longer. And it could be that could be 25 or 30 years that we're actually looking at. So I guess a question to you all out there just now is, have you thought about when you want to retire and what that might actually look like when you get to the other end? We'll just put out a quick poll and we'll just see who's thought about it. Yep, that's great. Most people have answered. So what we do need to think about is, what does it mean for us? Often what we can do is look back at our parents and say, you know what, they've lived a long life. My father passed away recently at 95. My wife's father passed away at 94. My mum's 89. So we are looking at an extended period. So what we have to be able to do is ensure that we've got sufficient assets to be able to really comfortably retire and enjoy that. So what do we sort of need? So there's a couple of things that we can look at. One is, what is a modest lifestyle and what does that look like for us as retirees? So a modest lifestyle, no eating out, You can only buy your clothes from a discount chain, no entertaining, can't drink. I don't know about you, but I have grandchildren, so drinking is very important. No private health insurance and a cheap holiday close to home. We'll see in a minute that a modest lifestyle can't even be funded by today's age pension from Centrelink. So we really need to actually put something in there and think about that ourselves. Most of us want a comfortable lifestyle where we're going through and we're basically being able to go out, we can buy the clothes we want, we can entertain, can drink. You're allowed to have private health insurance because we're going to go through that phase where we're getting older and everything starts to get a little bit creaky. And of course, we do want to be able to go on holidays on a fairly regular basis. One of the things that's very important when we're sort of looking at what is the number that we need when we get to retirement is you've got to break it down between what it costs to, say, run your house and have that life, say, on the left, and what are the things that might be on your bucket list. So when we show up and say, okay, well, for a modest lifestyle, you're really looking at sort of 34,500 for a couple, and for a comfortable lifestyle, you're up around that 59,000, 60,000. When I talk to clients, really what I'm saying to them, well, that's just that box. It's not taking into account anything that might be on your bucket list. So what we need to be able to consider is with that, say, $59,000, $60,000, how much do we need as a capital amount to be able to run that? And that's often something that can often scare people. So for us, the quick way of doing it is saying, okay, well, let's go 20 times. So 20 times 60 is about $1.2 million. If we've got a few things that we need to do on our bucket list, then it could be another 300,000 we need to fund our travel around Australia, our international holidays, and those sort of things. So it's a number of about $1.5 million. Anyone who's close to retirement and hasn't really saved along the way are really going to say, oh, I'm never going to get there. But certainly anyone who's starting out in the workforce today, or at least in their early 30s, should be able to comfortably get to a number that will allow them to have sufficient assets to run the retirement that they want. So then what we've got for older clients is to turn around and say, well, what we need to do is possibly use some of your own money while still accessing the age pension. So the thing with the age pension is that for a couple, it's $23,000 a year. With some small income rebates, it gets to about 28,000. So what we can see is our modest lifestyle cannot be funded by the age pension. So it is really important that we take the time to say, okay, we need to build up some wealth along the way to be able to subsidise what we're going to get from the age pension. So these days our life expectancy is around 82, 83, but for all of us, of course, it's different. It's also different for the amount of income you want. When we get into retirement and we're looking at these numbers, these income numbers, when you turn your superannuation from an accumulation phase, so that's what we're going through at the moment, we're trying to build that up, to the pension phase, when we receive that income in retirement after age 60, it is completely tax-free. So the gross and net number is exactly the same number. So it makes it a lot easier for us to be able to work out what it is we're doing as we go along. So things we can sort of look at, why do we use super? Why do I think that super is sort of the best place to start when we're looking at investing for our retirement? Well, we can make contributions. You've got your employer making contributions to super. That's effectively done from pre-tax. You can make contributions from pre-tax salary, and the reason we would do that is rather than paying income tax, which often for most Australians is somewhere between 30 and 37 cents in the dollar, that contribution is only taxed at 15 cents in the dollar. If your employer doesn't allow you to make salary sacrifice contributions or pre-tax, then what we're able to do now is the government changed the legislation to allow people to make what they call a deductible contribution from your own monies into super. So still, when it hits super, it's still going to be taxed at 15 cents in the dollar, but you can claim that as a tax deduction at tax time. There's also the $500 government co-contribution, and this is for $1,000 after-tax contribution being made. Be very careful because it's really for low-income earners. So you're sort of looking for those on $37,000 and less. They put in $1,000, they will get the $500. It cuts out at about $46,000, $47,000. The other one you can use is if you make a spouse contribution of $3,000 per annum, then you're entitled to a $540 rebate. So there's a couple of things certainly for low income earners that can be used, or for especially spouses that you might be wanting to top up contributions as you go. Why do we want to use super? We've got the contribution differential in tax that sits there that is very worthwhile, but it's also there for the earnings on your superannuation as you go. So you know that if you receive your income as your salary as income and then you go to invest it, you've had to pay your marginal tax rate on those monies to start to invest. Any returns on that are then also taxed at your marginal tax rate. Inside super though, the earnings on your fund is taxed at a maximum of 15%. So most portfolios have a certain amount of shares and that sit inside there, which mean that the actual long-term tax rate that you're going to have is probably closer to 7 or 8%. So there really is a substantial difference between the returns you're going to get inside super versus those from outside. One of the other advantages is when you go from the accumulation to the retirement phase, there's actually no capital gains at that point either. So super is definitely the place we look at first, and then we want to look and say, okay, well, what else might we need to do? As we get to retirement, we get actually no earnings, no tax on the earnings inside superannuation when we're in the pension phase. And then the income, most Australians now, the preservation age is age 60. And so that means when you retire after age 60, you can receive this income tax-free. So that's pretty cool. The earnings are tax-free and the income is tax-free. So that's why we are always heading towards that. So what we need to look at is say, okay, well, what are the different sort of levers that we can use to help really build our superannuation up? There's only three big ones that I can think of. That is, how have we got our money invested? What are the contributions that we're going to put towards it? And how long do we want to work for? So that last one, really, you know, you might set yourself a goal and say, okay, 62 sounds like a great age to retire, but you get to 62 and you haven't quite got enough, so you can work another couple of years. You get to 58 and you go, you know what, my super's tracking really well. In a couple of years, I'll be able to retire. And so you might be able to retire at, say, 60, but you can move that to make it actually work for you. We'll start off and have a quick look at the investments. How many of you have made an investment choice on your supers? We've just done another quick poll. You can just quickly answer that for us. Great, thanks for doing that. So what we really look at is there's only four main asset classes in which we can invest when we're looking at either inside super or outside super. So really you're looking at cash, low return, low risk. What are we talking about when we say risk here? Risk really in the short term is the possibility of a negative return, which a lot of investors don't like, but it is really important that we kind of understand what that means. Risk in the long term is that you're actually not aggressive enough to get the return you need to have the capital that you want when you get to the other end. And that to me is a worse level of risk than say a short-term negative. So really what short-term is, it's volatility, which we see in our market on a regular basis. So if you're a younger person, what you want is all your money really sitting up in that top right-hand box in property and shares. Whilst we might want to be on the left-hand side up the top, that's where most Australians go, yep, I want great return, but no risk. There really is no asset class that sits inside there. So what you've got to determine, what is that long-term return that you want? So shares give us about 10%, property is about 8%, and it's commercial property, so it's CBD buildings, shopping centres, industrial estates, that sort of stuff. It is not residential property. Fixed interest and government bonds, and then cash. So fixed interest is about 6, cash is about 4. So you can blend that to what you need to get the right asset allocation for the return that you need. So really what you've got to look at is, what is your time frame? How do you feel about it? Are you going to make more contributions? What is it that's going to allow you to make that investment choice? So certainly the longer time frame you have, then the more growth assets you can have inside your portfolio. Often people look at retirement age as a date that says, okay, this is the end of my investing, but it's not. You're going to be invested all the way through retirement. So we actually still have a long time frame even when we get to retirement. and that's the fun. We want to be there for 20 or 30 years having a great time. So it can't be too conservative. However, if we've got a great level of asset, then we can certainly take some of that volatility out by having more defensive assets sits inside our portfolio at that point in time. So the other arm we've got is contributions. So the government has recently made some changes around the limits that you're allowed to put into super. So on the left-hand side there, we've got the pre-tax or salary sacrifice type contributions. So previously, if you were under age 50, then you could put a maximum of 30,000 a year, which does include your employer contribution. If you're over 50, you're allowed to put 35. From 1 July last year, so we're looking at this financial year, the maximum is $25,000, including your employer's contribution. Be careful to ensure that you don't exceed that. Not that a penalty is imposed on you, because thankfully they changed the legislation to allow that if you did breach that cap, then the tax payable on that would be just at your marginal rate. The other one that we use quite a bit for people getting closer to retirement is this post-tax or after-tax contribution. And this is generally used when you're getting closer to retirement, you've sold an investment property, you've sold down a share portfolio, because what you want to do is try and get that into superannuation, into that tax-friendly environment. So you allowed those assets to be available prior to retirement, which is why you had it outside super, but now you're putting it inside. So previously you could do 180,000 per year, that's come down to 100. You're also able to use what they call the bring forward provision. So that 180, we could actually, you put in 540,000. So if you did two contributions, one in June of 180, one in July of 540, then for a couple, you're getting, the best part of $1.4 million into super. And most people go, yep, that's pretty much the number I need to be able to retire comfortably. Now it's back to 100, still have the bring forward provision, which allows us to put 300,000 in 1 year. So you do the July again, so it's 100, 300. So for a couple, a maximum of 800,000 during that period. The other thing to look at as well is really, have I brought all my supers together? Now, there are reasons that a lot of clients have multiple superannuations, and some of that can be around insurance. So the thing to look for is to say, okay, what are the levels of cover that I need? Should I be bringing them in together? What are we looking at in regards to all the different fees on all my different supers? Lifestyle's here to help you with those. If you've got a few questions around, should I be bringing my super together? Please try and contact us if we're out at your office. Talk to us then. Otherwise, by all means, give us a call, because we're always happy to help. So inside your superannuation fund, and it doesn't matter whether it's an employer default or whether it's an industry fund, you should have some level of cover. And these covers go across death cover, total and permanent disablement, and salary continuance. And there's certainly different parts of our lives where these covers are really important. If you jump onto our website at some stage, our taking control booklet's on there, and it goes into all these things in a lot more depth. But if you're looking at employer super funds, you're basically getting these insurances at wholesale rates. It can be paid out through super at that point in time, and in joining the employer fund, you'll get these under automatic cover. And what that means is you get the level of cover that's a default level, and you haven't had to provide medical evidence for it. So for some Australians, that's an absolute huge bonus. So in trying to determine the level, we've got a few things that we need to think about. How much are my ongoing expenses? What debt do I have? One that's not on there is how old is my youngest child? So these are factors that determine how much actual cover we need. Be always mindful that as you get older, that what you need to do is start to reduce these levels of cover. So why am I talking about insurances? Well, wealth creation is also got wealth protection in there. So what you're looking at is your family. So these things are extremely important to look at as we go. So with your super, the beauty that we have now is you can actually make a binding nomination. And what that does is it binds the trustee of the superannuation fund to pay your super in the guidance that you have set for them. You have to be careful that the nomination you make is a valid nomination. So that's a spouse, child, someone who's financially dependent on you, or an independent relationship. So that non-lapsing binding is what you want. So the first one there is a non-binding nomination. So you can really put anyone down, but then the trustee is going to make a decision, and generally that is they'll pay it to your estate. The binding nomination paid in accordance, and no nomination, it will just automatically go to your estate. So those things that I've sort of covered on today is just sort of giving you, I guess, the tip of the iceberg from our perspective of some things that you need to think about when you're going through and looking through your working life. So mortgage, kids, and trying to save for retirement. And then in retirement, what are some of the things that we need to have as considerations? Our contact details are on the screen for you there. Feel free to contact us or email us. We're happy to help in any way that we can. That's basically the set of slides for me. What we'll do, we'll be online for about another 5 or 10 minutes. Anyone got any additional questions, please send them through and we'll do what we can to help answer those. We'll also be sending the presentation out and we'll go through and do a question and answers for everybody. Thanks everybody for attending.